Every smartphone in your pocket, every data center training artificial intelligence models, and every precision-guided weapon system relies on microchips that cannot be manufactured without a single company headquartered in a small Dutch town most people have never heard of. That company is ASML, and it has built what is arguably the most economically consequential monopoly of the 21st century. Not a monopoly over oil or steel or even software. A monopoly over light itself. To understand the economics of ASML, you first have to understand what the company actually does. Microchips are etched onto silicon wafers using a process called lithography, which is essentially photography at the atomic scale. The smaller the features you can print, the more transistors you can pack onto a chip, and the more powerful that chip becomes. For decades, this industry chased Moore's law by using light with progressively shorter wavelengths. But around 2005, the industry hit a wall. The wavelength of light they were using could not print features small enough for the next generation of chips. The entire semiconductor roadmap was in jeopardy. ASML solved this by developing a machine that generates light using a completely different wavelength, 13.5 nanometers, in the extreme ultraviolet spectrum. These EUV machines are the only tools on Earth capable of producing the most advanced processors, and ASML is the only company that makes them. The story of how a Dutch startup founded in a leaky shed achieved this position is one of the most remarkable business narratives in modern history. On April 1, 1984, electronics giant Phillips and chip equipment manufacturer ASM International created a joint venture called ASM Lithography. The goal was to commercialize a wafer stepper that Phillips had developed internally, the PA's 20000. The new company began life inauspiciously, housed in a sticky shed next to a Phillips office building in Eindhoven. Of the 50 engineers Phillips offered the chance to join this risky startup, only 47 signed on. The others preferred the security of a job for life at one of Europe's largest conglomerates. Within a year, the company moved to newly built offices in nearby Veldhoven, hired its 100th employee, and brought its PA's 2500 stepper to market. That same year, 1986, ASML established what would become one of the most important partnerships in industrial history with German optics manufacturer Carl Zeiss. Yet the early years were brutal. By 1988, ASML had only a handful of customers and was burning through cash faster than it could generate revenue. Shareholder ASM International, unable to sustain the investment with so little return, sold its stake and exited entirely. Phillips announced a sweeping cost-cutting program. The young company's survival hung by a thread. It took the personal intervention of Phillips board member Henk Boot to persuade his colleagues to extend one final lifeline. That decision, made under duress in the late 1980s, would eventually prove to be one of the most consequential corporate rescues in history. Without it, the entire trajectory of global semiconductor manufacturing would look radically different today. The breakthrough came in 1990 with the launch of the PA's 5500 platform. This system offered industry-leading productivity and resolution, and it finally made ASML profitable. In 1995, the company listed on both the Amsterdam and New York stock exchanges, and Phillips gradually sold its remaining shares, making ASML a fully independent public company. But going public was only the beginning of the real story. The company that emerged from Veldhoven in the mid-1990s was still a distant second to Japanese lithography giants like Nikon, which had dominated the market for years. ASML needed something more than incremental improvement to overtake them. It needed a technological leap that would redefine the entire industry. That leap came in two parts. The first was TwinScan, introduced in 2001. This dual-stage system exposed one silicon wafer while simultaneously measuring and aligning the next, dramatically increasing throughput and accuracy. The second, and more consequential, was immersion lithography. By placing water between the lens and the wafer instead of air, ASML's engineers discovered they could achieve far higher resolution without changing the wavelength of light. In 2003, ASML produced the industry's first working immersion lithography prototype, the TwinScan XT1150i, by 2004. The first pre-production systems were shipping. This technology bought the industry another decade of Moore's law, but everyone involved knew it was a temporary reprieve. The physics of light meant that even immersion lithography would eventually run out of road. The real prize was something that had been discussed in research labs since the 1980s, but that no company had successfully commercialized: extreme ultraviolet lithography. EUV lithography is not merely an incremental improvement. It is an entirely different approach to manufacturing that required solving problems no industrial company had ever faced. The light source works by firing high-powered lasers at droplets of molten tin 50,000 times per second, creating a plasma that emits light at 13.5 nanometers. This light is then reflected off mirrors so perfectly polished that if they were scaled to the size of Germany, the largest imperfection would be less than the thickness of a human hair. The mirrors are housed in a machine the size of a double-decker bus operating in a vacuum because EUV light is absorbed by air. Each machine contains over 100,000 components, weighs approximately 200 tons, and requires 4 cargo planes and 20 trucks to transport. The development of EUV was so expensive and so risky that ASML could not fund it alone. In 1997, a research consortium called EUV LLC was formed in the United States with support from Intel, Motorola, and AMD. Crucially, the U.S. government granted special approval for ASML to participate in this consortium while excluding its Japanese rival Nikon. This decision, made in 1999, would prove decisive 15 years later when EUV finally reached commercial viability. But even with research support, the path to a working production machine remained uncertain. By 2012, ASML faced a critical juncture. It needed billions of euros to complete EUV development and simultaneously prepare for the industry's transition to larger 450mm silicon wafers. Rather than dilute existing shareholders through a traditional equity raise, ASML devised one of the most unusual financing arrangements in corporate history. In July 2012, ASML announced its customer co-investment program. Intel agreed to purchase 15% of ASML's shares for approximately 2.5 billion euros and commit 829 million euros in research and development funding. Taiwan Semiconductor Manufacturing Company, better known as TSMC, acquired 5% for 838 million euros. Samsung acquired 3% for 503 million euros. In total, these three customers bought 23% of ASML's issued share capital at 39.91 euros per share and committed to fund 1.38 billion euros of ASML's R&D between 2013 and 2017. The proceeds were returned to existing shareholders through a synthetic buyback. The message was unmistakable. The world's largest chip makers were so dependent on ASML's success that they were willing to become part owners of their own supplier. TSMC sold its entire stake once the lockup period expired, treating the investment as a gesture of support rather than a long-term holding. Intel gradually reduced its position over subsequent years. Samsung, ironically the most skeptical of the three at the time, may have been the only participant to benefit from ASML's subsequent share price appreciation, which rose roughly sevenfold from those 2012 levels. The first EUV lithography machine was delivered in 2010, but it would take years more before the technology was reliable enough for high-volume manufacturing. By 2016, the industry was approaching a crisis point. Chip makers could no longer shrink transistors using existing immersion technology without resorting to increasingly complex and expensive multi-patterning techniques. EUV had to work, or Moore's law would effectively end. ASML's engineers, working with Carl Zeiss on the optical systems and Cymer on the light sources, gradually solved the reliability problems. By 2022, they had become indispensable for any chipmaker producing processors at the 7nm node or below. ASML had crossed the threshold from promising technology supplier to absolute bottleneck in the global semiconductor supply chain. This is where the economics become truly extraordinary. An EUV machine costs approximately $150 million. The next-generation high-NA EUV machines, which Intel began installing in 2024, cost roughly $350 million each. ASML's gross margins consistently hover between 51% and 53%, a figure that would be exceptional for almost any hardware manufacturer but is particularly striking for a company building machines of such staggering complexity. In 2024, ASML reported total net sales of 28.3 billion euros and net income of 7.6 billion euros. Research and development spending alone reached 4.3 billion euros that year, representing roughly 15% of revenue. The company employs over 47,000 people worldwide, with approximately 57% based in the Netherlands, and maintains a network of 5,150 suppliers, of which 1,600 are located in the Netherlands, and the vast majority in Europe. The business model is built on a flywheel that is difficult to replicate and nearly impossible to disrupt. Each EUV machine generates recurring revenue through service contracts, software upgrades, and spare parts for its entire operational life, which can span decades. The installed base management business contributed billions in annual revenue even before considering new system sales. Because each machine is essentially a bespoke integration of optical, mechanical, and software systems, customers become locked into ASML's ecosystem. Switching to a competitor would require retraining thousands of engineers, redesigning manufacturing processes, and accepting lower performance. For the most advanced chips, there is no competitor to switch to. ASML is the only source. This monopoly is reinforced by supply chain relationships that are deeper than typical vendor arrangements. Carl Zeiss SMT, the German optics subsidiary that supplies all of ASML's EUV projection systems, has no other customer for this technology. ASML holds approximately a 25% stake in Carl Zeiss AG, and the two companies have co-developed EUV optics for over 25 years. The multi-layer mirrors, illumination systems, and high-NA anamorphic optics are the result of joint development with no independent equivalent anywhere in the world. Similarly, ASML acquired Cymer, its light source supplier in 2012, and relies on German laser manufacturer Trumpf for the high-powered carbon dioxide pulse lasers that drive the plasma generation. No other company can simply enter this market by hiring engineers and building a factory. The knowledge is distributed across thousands of specialists, dozens of companies, and decades of accumulated experience. The competitive landscape reflects this reality. Nikon, once the dominant force in lithography, scaled back its EUV research efforts around 2009 and never recovered. Canon has focused primarily on legacy nodes and non-semiconductor applications. China's Shanghai Microelectronics Equipment, or SME, is attempting to develop domestic lithography tools but remains years behind ASML's EUV systems, with significantly lower overlay accuracy that limits production to nodes above 14 nanometers. For the foreseeable future, any company anywhere in the world that wants to manufacture the most advanced chips must buy from ASML. This position has made ASML one of the most valuable companies in Europe. By 2024, its market capitalization had surpassed that of LVMH, making it the second largest publicly listed company in Europe. By early 2026, it crossed the $500 billion mark. The stock trades at a premium valuation, with price-to-earnings ratios frequently above 50 and price-to-sales ratios in the high teens, reflecting investor confidence that ASML's monopoly will persist and that demand for advanced chips will continue growing. That demand is now being driven primarily by artificial intelligence. The massive data centers powering AI models require processors with transistor counts that simply cannot be achieved without EUV lithography. Every major AI chip, from NVIDIA's GPUs to Google's TPUs to the custom silicon being developed by Amazon and Microsoft, depends on manufacturing processes that run on ASML machines. Yet owning ASML is not without risk, and the risks are unlike those facing almost any other company. The most immediate threat is geopolitical. In 2023, the Netherlands expanded export controls on advanced semiconductor manufacturing equipment, restricting ASML's ability to sell certain deep ultraviolet immersion systems to China. In September 2024, further Dutch restrictions took effect. By 2025, China revenue had surged to approximately 33% of total sales as Chinese chipmakers stockpiled equipment ahead of anticipated restrictions. But ASML forecast that figure would normalize to around 20% in 2026. In April 2026, U.S. lawmakers introduced proposed legislation that could block not just sales, but also servicing of EUV immersion tools to Chinese customers. Analysts estimated this could reduce ASML's earnings per share by up to 10%. The geopolitical dilemma is acute. CEO Christophe Fouquet, who took over from Peter Wennink in April 2024, has emphasized both the AI-driven demand opportunity and the need to navigate an increasingly fragmented global technology landscape. His predecessor had been a vocal critic of export restrictions, arguing that they disrupted supply chains without achieving their strategic goals and risked accelerating China's domestic equipment development. Fouquet has taken a more measured public stance while acknowledging that geopolitical considerations are now a permanent feature of ASML's business environment. The company finds itself caught between its Dutch headquarters, its American technology dependencies, its Asian customers who generate roughly 80% of revenue, and the Chinese market that still represents a significant portion of sales for older equipment. There is also the risk of technological transition. ASML delivered its first high-NA EUV system to Intel in late 2023, and Intel completed installation of the first commercial unit in 2024. These machines, designated EXE5000 and EXE520, achieve a numerical aperture of 0.55 and can print features down to 8 nanometers. But adoption has been cautious. TSMC, ASML's largest customer by volume, has been slower to commit to high-NA for commercial production, with some analysts projecting adoption around 2028 rather than immediately. Samsung and SK Hynix have placed orders. But the timing and volume of high-NA ramp remains one of the biggest variables in ASML's revenue projections for the late 2020s. If customers delay adoption, ASML's unit shipment forecasts for 2028 and beyond may require downward revision. Then there is the longer-term question of what comes after high-NA. ASML has discussed Hyper-NA systems with a numerical aperture of 0.75, potentially arriving around 2032, but no formal commitment has been made. The decision to proceed depends on whether Carl Zeiss can manufacture the required optics, whether chip makers can justify the economics, and whether alternative technologies such as directed self-assembly or advanced packaging reduce the need for ever more complex lithography. ASML cannot commit to a Hyper-NA timeline without Zeiss confirming that the necessary optics can be designed and manufactured, which means the pace of semiconductor advancement beyond the current roadmap is effectively determined by what one German optics company can achieve. The cyclical nature of semiconductor capital spending adds another layer of complexity. Chipmakers tend to invest heavily in new capacity during periods of strong demand and then cut back sharply during downturns. ASML's order backlog exceeded $45 billion at the end of 2025, providing substantial visibility, But the company is not immune to these cycles. In 2001, following the dot-com crash, ASML's sales plummeted 40% and the company was forced into significant layoffs. The memory chip sector in particular has historically been volatile, with periods of oversupply leading to canceled or delayed orders. While AI-related demand has provided a powerful growth engine, it is benefiting ASML's customers unevenly, creating both opportunities and risks that are reflected in the company's wide revenue. Guidance ranges. For investors, the economics of ASML come down to a bet on the continuation of trends that have defined the technology industry for half a century. If transistor density continues to matter, if artificial intelligence continues to require more advanced silicon, and if no competitor emerges to challenge ASML's position in EUV lithography, then the company will likely remain one of the most profitable industrial enterprises on Earth. Its margins, its pricing power, its installed base recurring revenue, and its technological moat are the envy of virtually every manufacturing company. But those same characteristics make it a geopolitical lightning rod, a company that is indispensable to the production of advanced weapons. Artificial intelligence and telecommunications infrastructure cannot expect to operate as a purely commercial entity. It will continue to be pulled into trade disputes, export control regimes, and great power competition, whether its management wishes it or not. The ownership structure reflects this global entanglement. BlackRock is the largest reported institutional shareholder with approximately 6.8% of shares. Capital Research and Management holds roughly 5%. The remaining shares are widely distributed across global institutional and retail investors. There is no single dominant owner, no government golden share, and no strategic investor with the power to dictate ASML's commercial decisions. This has allowed the company to maintain a degree of operational independence, even as governments in Washington, Beijing, Brussels, and The Hague all seek to influence its behavior. Looking ahead, ASML's trajectory will be shaped by forces that extend far beyond its control. The US-China technology competition shows no signs of abating. The European Union is increasingly focused on strategic autonomy in semiconductor manufacturing. Taiwan's geopolitical status remains the single greatest risk factor in the entire chip supply chain. And the physics of lithography is approaching fundamental limits that may require entirely new paradigms. ASML has navigated all of these challenges with remarkable success so far, but the next decade will test whether a single company, even one with a monopoly over the most critical technology in the world, can remain insulated from the political and economic turbulence of a fragmenting global order. What makes ASML's economics so fascinating is that they are simultaneously straightforward and unprecedented. The company sells machines that cost more than private jets, generates margins that software companies would envy, and faces demand that is structurally driven by the digitization of everything. Yet it cannot choose its customers freely, cannot ignore geopolitical boundaries, and cannot assume that today's technological lead guarantees tomorrow's dominance. The investors who own ASML are not just betting on semiconductor demand or Dutch engineering excellence. They are betting that the world will continue to need a company that can manipulate light at wavelengths shorter than any commercial technology has ever achieved, and that no one else will figure out how to do it cheaper or faster. In the end, ASML's value is a mirror reflecting what society has decided is worth paying for. We have collectively determined that artificial intelligence, advanced computing, and digital infrastructure are worth the cost of machines so complex that only one company can build them, so expensive that only a handful of customers can afford them, and so strategically vital that governments are willing to reshape trade policy around them.